go.
So I tried to pick a random stock, like you said this time, stock that we haven't worked with before. So I just picked Caterpillar. Mainly I just picked it because I saw that it's at its all-time high, so I thought it'd be an interesting one, considering the fact that we're like, consider we're in a downturn. This is still like almost at its all-time high, so I just thought it was interesting, and I wanted to use the stock to kind of just look into it a little further and figure out how I would enter this if I were to. So I drew my fib starting with the monthly, weekly, and daily, and I didn't draw weekly because it was like exact correlation with the monthly, and so I just went to the daily, and what you see, the solid lines is the daily fib, and then the dotted line is just the hourly fib transposed on the daily. I wanted to see it on both the daily and hourly, although I think I only pulled the trigger on the hourly. So this is what it would look like if you just look at it on the hourly.
Okay.
But let me zoom out a little bit. Instead of because I didn't have enough time to do a lot of homework this week, I just went straight and tried to find the areas of opportunities and where I would essentially enter if I were to enter either on the upside or downside. So the first one I picked as I was just kind of looking through is this one that kind of stick out to me as a potential entry point. And this would be the engulfing entry. As you can see, the wicks and the of each of them, of both of these right here at an area at this peak, are kind of just engulfing each other, and clearly we're kind of on a downtrend right here, making lower and lower highs as we go.
I have a couple of questions. Like that engulfing says it's the downside because we have hindsight. We see that it went down. But my two questions for you is, why to the downside? Number one, and two, what fib level told you it's time to get in?
So I didn't use the fib to make this decision. I didn't have enough time, unfortunately, to draw all of my fibs. But I kind of just looked back and said, okay, if I didn't have hindsight and I can see to the right and I would just look backwards, I can see that this is a continuation, right? You can see it was on the upward trend until right here, it kind of started making lower highs. So this is essentially a reversal to this way. So I started looking back, and then I tried to identify an area of opportunity.
Why not where your mouse is right there? Why not that point?
Yeah, I think primarily because I was as I was scrolling from left to right, or from right to left, and then I kind of just, this stood out as me as a engulfing signal, okay. And then I just used that one. So I try to use one example of each, but I guess this one could also work as an engulfing. This actually would be better, because this is a much better retracement. If you were to draw this fib right here, from here to here, you kind of wanted to get to that, like, green to green zone around the 50% to get a nice retracement, which would be even more than this one right here. So if I were to, I can draw it real quick just to look at it. So if I were to draw this, and let me move it down. And then here you see a nice pullback, and then even a better one right here, right around the 61.8. And then you get this engulfing one. So you would pull the trigger essentially at the end of this, essentially right here when it gets to November 22nd.
Yeah, I like this one better than the other one. The other one worked because we know it has worked because we see it.
Yeah.
I think decisions has to be made though, like mechanically. right?
Mm.
XYZ happens, I pull the trigger, not because I saw it, you know, from last week. I can see that this was this kind of pattern. Uh,
Yeah.
you might even want to try to do something like do a replay mode and go back to a X date, and then as you move forward, make decisions.
Mm.
That way, you don't have the right side of the chart visible to you. That's one way
Yeah.
to do it. Another way to do it is as you start to go into paper trading, you only trade forward, right? So daily,
Yeah.
you get to
That's true.
practice that portion. Okay.
Okay. Sounds good. What was the biggest part about this one you didn't like? I'm just curious. I know this
Uh,
one, it's a full up bar, so it's nice. You get to see the red and the green, the full part, and small wicks, so it's a better engulfing bar. But I wanted to understand why, besides the retracement, that was the biggest one that stood out to me when you pointed this one out, because it's a
okay.
nice retracement and you have a potential for a nice bounce back. But I'm curious to why you think so.
So first, that first one is not engulfing really. It does railroad tracks to me
This
because
one?
it's yes. Engulfing
Okay.
means the body of the new bar completely engulfs the previous bar.
Okay.
So the where you have the circle, it looks
Yeah.
like engulfing more
Okay.
on that side, but on the first one, it went up and went down same amount, right? So that's
Yeah.
um, there is a Japanese term for it. It's called Marubozu, something like that. I don't know how to say it, so I think it's Marubozu. So I just say railroad tracks. It's easier to remember. Up and down about equal. Engulfing is the one to the right
Yeah.
completely takes out both the high and low of the previous bar.
Mm.
But going back to your question, it's not that I don't like that entry. It's I think from a candlestick formation, it's nice. It's lower high, right? The one where I'm suggesting you take the entry is lower than that, so you have lower highs forming with lower lows. It's a beautiful
Yeah.
place to enter, but for our if you have a set of rules and it doesn't fit into those set of rules, then you're gonna get into a bad habit when it's time to trade real money. Here you only picked it because you see it.
Yeah.
But if it fits a rule, and you say, hey, look, I see it, but based on this rule, it also fits the rule. That's what I'm going to trade is rules only. And everything that is good on the chart, you're not taking because one, you don't have that luxury to know the future, but two, it doesn't fit your uh, plan, your trading strategy, your trading plan. So it's really critical to do that. Now, if you had redrawn this fib from Humerus and redraw it from the peak of where I said to enter,
From
yeah,
here?
take that there, and then take the low to the next low. Yes. Where does it come? It comes right at the 78.6,
Uh,
right? It comes right there. And now, if you had said, this is why I take this trade,
mm,
yes, but to redraw this, if you go back to the original drawing, this is where all this exercise is critical, is this original drawing, it broke above the 38.2, that's why you redraw it,
yeah.
right?
So you'd move it. Yeah.
So you move it. It fits the
Mhm.
trading plan.
Nice.
This is how I want you to think about these trades. Is just ignore the being right and wrong, right? You want to be right, and so you're nitpicking the ones that are right. But if you choose the plan and you trade the plan, you'll also pick the wrong ones. Because in real life, you don't know the wrong ones until they happen.
Yeah.
So the critical part is, this is my plan and I'm trading this plan. And then all you do is identify those three candlestick patterns: railroad tracks, engulfing, or hammer. Hammer includes the upside down hammer, or consolidation, which is a pennant or a flag. So those are the only four conditions you want to look for. If you only trade these, I guarantee you'll become successful. Right? Sometimes we get nervous and say, you know what, I didn't get a trade for the last 3-4 days. Let me find another pattern. And now you have to study this new pattern. You don't know how this pattern works. Right? So in order to avoid that, just focus on these four. When you become really good at these four, you can start adding to that. Like, in front of me, I have trade chart patterns, and it has 1, 2, 3, 4, 5, 6 by 4, 24 types of patterns on it. Right? And it's when you're really experienced and you don't see something forming, or you see something forming and you don't really understand, you can look at that. Oh, okay, that's forming, and that one says it's better to take to the downside, then you take to the downside, or vice versa. But until you get there, just focus on these four, and these four in combination with your Fibonacci. Right? Your Fibonacci tells you the dynamic support and resistance.
Yeah.
We go back to the basics, right? You have your zigzags, you have support and resistance, and support and resistance drawn to you by dynamic Fibonacci retracements. Right? That's how we keep simplifying it.
Nice.
So if you scroll now where you said you had your entry, it really worked, right?
Yeah.
And then did you have any other entry after that?
What do you mean? You mean another drawing that I made?
Yeah.
Yeah, I have a few. Let me find the other one. This is another one right here. So, yeah, I noticed like this was all going higher, higher, higher. We got a reversal right here, and then this is another continuation. And then you see the consolidation right here. So I took the high point of the consolidation area, and then the low point where the consolidation kind of ends, to determine my entry point. And that's this right here. So the next morning, I would enter right at the lowest point below the consolidation area, which would be right here. I can zoom in a little bit more so you can see better.
I'll tell you, I'd be very hesitant to take this trade. One, look how far it came down from the high before it consolidated. Right? So it went from 240 to 211, and then it consolidated. So reason why I say I would be hesitant is I have nothing else to go by. Like, there's no fib to help me understand, like, am I coming to some retracement? Could it reverse from this retracement? Or in this downtrend, if you draw the fib now just for the downtrend, to that first, go to the first low on the left, right? And so you don't have to click the, it breached the 38.2.
Yeah.
So you can draw it from there, or you say that, you know what, that's not close enough, so I can just move it either way, right? Because the 38.2 is a zone, it's not a scientific point. So here, you can say, you know what, I retrace close to 23.6, but like I said, in a big move like this, I'm a little hesitant. And if you consider the whole move, after the consolidation, yes, it moved down, but very little in comparison. Right, in comparison. So not to beat you up on that, but I just want you to really get it, ingrained in your brain. Like, I must see why I'm entering this position. Like if you switch this to a weekly chart, and do you know where that area? Yeah.
Let me find it real quick. There it is.
So if you had drawn your fib from left to right, you're yeah, going higher fib, and is that what we're seeing there? Those dashed lines.
Yeah, the
So
fib,
it
the
came
monthly.
to 23.6.
Yeah.
And is that an entry to say I'm gonna keep going down? Not not in my rules, right? The rules that I gave you is this is a continuation, so you're looking to the reverse side actually. That's what you're looking for as an entry. But because you can see it, you say, hey, this works, so let me choose it. But it doesn't fit the rule.
Yeah, because you'd want it to come here and then bounce, and you want to enter on the reverse.
Yeah, that's what you want to see, right? When it came to that 38.2, it gave you a hammer.
Yeah.
Right? At the 38.2. Yes, right there. No, the 38.2. When price comes down to it.
Right here?
Yes.
Yeah.
Yes, it doesn't stick out, but roughly, if you had said, hey, this hammer is close enough, I enter, I would agree more on that one. Again, even though we can see that that has not really worked well, I still want you to take that trade because that's what fits the rule, right? Eventually, over a period of time, that's how you have winning trades, is because you have a set of rules that you're following, right? You have the plan that you're following, you're executing that plan.
Yeah.
But even that trade worked for a little bit, right? So you would have not taken profits where you could, but uh, it worked for a little bit. And then that whole area by itself becomes a consolidation. It consolidates, slowly dipping down, it consolidates, and then it moves up.
Yeah, that's why right
Yeah, all the way to the right, right? It keeps consolidating.
here. Yeah, right here.
Yeah.
Actually, this whole thing.
It hits a high, it drops. It hits a high, it drops.
Yeah.
Yeah.
Okay.
But that's good. It's good for the first round.
Okay. I had one last one. I can quickly show you.
But if that last one is based on the same kind of knowing what the forward looking is, I think we can skip that one.
Okay. Sounds good.
Okay.
All right. I'll let Nev share then. I'll stop sharing.
Yeah, I mean, I actually didn't get a chance to practice too much.
Okay. So today we're just gonna keep re-emphasizing those entries, right? To the upside, to the downside. Everything has to do with support and resistance. I mean, whichever way you want to draw it, right? Very much, that's what we're going to focus on. Those entries, and then finding areas where price could reverse is the most important part, right? As we talk about Fibonacci retracement, so support and resistance dynamically. But the other things that I mentioned last week is looking at gaps. Every time there's a gap, I treat that as some sort of a support or resistance. When price comes back to that gap area, it wants to close the gap and reverse it. So keep that in mind as you're studying your various charts, right? So keep that in mind. Here, when I said, hey, I'm expecting price to come up to somewhere in this level and drop, we have not closed this gap yet, right? Left open for a while now, since September 13th. We have this gap down that we have not really closed, so that could potentially act as some sort of resistance with the supply zone up here. So because there's a lot of things drawn on here, I will use your Caterpillar's competitor, Deer. We can use that as a starting point to look at.
Real quickly, before
Yes.
we move on too far, I thought at some point previously you mentioned wherever there's a gap, the charts look to close that gap. So why wouldn't it act as resistance if the inclination is to close the gap?
Yeah, so that's a good question. So here's what I mean by that, and it's good to address that question. It's a very important question. So here's a gap that we created, and when it comes somewhere between halfway or all the way 100%, and I always mention 50% of that gap. This is where I have those dashed lines. It's considered closed. You'll notice that when it hits this zone, it reverses, even if it's temporary. That's why I say it acts like resistance. It's a feeling that, hey, I got down, I want to continue to go down, but I want to come and collect some more orders. Some more orders. When I say I'm not talking about retailers like us, I'm talking about institutions. They took the price down, but they don't want to chase, so they want to bring it back up here, close this gap, and take it back down or take it back up, whichever the scenario was. That's why I say it acts as support or resistance. It closes it, it acts like it. It could, like I said, be short-lived, right? It acts as a resistance, and then price could do this. Once it's closed, it's removed from the picture, and we don't talk about it again, right? That's what I mean by resistance. It doesn't have to be long-lived, and if it's not 100% closed, if you only want to see 100% closed, you wait until you get that 100% close. As you can see, this acted as resistance. Like it's exactly the example I showed you. Short-lived. Price did this. Very short-lived because it knew it closed that order. So no matter how long it takes to get that taken care of, they'll figure out a way to take care of it. Very rarely will they not take care of it. So this one is taken care of, right? But there are a few that get left open. But let's look at this one. This one is actually another interesting one. On this particular one, they closed the gap. They pretended they don't want it to act as resistance, but they took the price down still. Why? Very simple. We follow breadcrumbs. Lower high, lower high, lower high, lower high. We just follow breadcrumbs. Right? That's what we trade. If we had said, hey, did price come back to test this and go higher? And if we go to our basics and say, when I break this, I will enter to the upside, that would be the right decision. But we did not see that in this instance. Right? All we saw is it closed the gap, but it stayed in consolidation once the gap was closed, and then price reversed. So is it making sense now why I say it acts as support or resistance?
Yeah, it makes sense. Temporarily, and then obviously then it moves whichever direction after that.
Yeah, we don't know, for how long, especially if it happens very quickly after the gap was left open. It means they just want to keep taking price in that same direction. If it took a while, like in this case, I think somewhere around here, when it closed that previous gap here, it was short-lived because it took a while. Like it was more than a month or even longer. What date was this? Yeah. So May 19th, right? It took 5 months for them to come fully close that gap. So after 5 months, it should most likely be short-lived. But here, what we look for is this is a perfect example. Actually, let's redraw this. Can we do Control-C? Yes. Was it this one? Or no, the previous one? Sorry. I'm gonna... Yes, this one. Let's do this one. So if we say we're on a daily, we see a downtrend, we draw our fib. It didn't close above the 38. This one didn't close, so I'm just gonna keep redrawing it. This one, you can say it's close enough, so I do this. So here we're seeing it is testing the 70%, right? And it wants to keep going up. So as you see this, and then you see, oh, it's making higher highs and higher lows. If we do this on daily, and then we draw, this one is closed, so we do this one and make this intraday. Okay. So here you see that price kind of, it closed the gap, so that's one of your areas where you say I'm cautious. It's not at 78.6, so it could still reverse. I'm very cautious, but as I look at the recent trend up, do I have a candlestick pattern that suggests I could go to the upside? You put all things together. Everything we've learned, we put it together, and this gap here, it's a long ways away. It was 5 months ago. As a result, with price making higher highs and higher lows, you could potentially start thinking this could be a reversal, right? This is a reversal. I'm not suggesting you take reversal yet, right? So because we've talked about only take the one side for now. But when you say this could be a reversal, and then you see this bar and this bar, this is almost engulfing, right?
Yeah.
So for engulfing, I would like to see the full bar inside the next bar. Now this
is that including the wick or without the wick?
No, it's including everything.
Okay.
But the best ones is where the body has very little wick. Like it starts at the bottom, it finishes at the top. That's a very, very convincing engulfing bar. But this one is engulfing. As you can see, it's a 3. So it took out the low, it took out the high. This is a good engulfing bar to enter this trade. Because everything lines up. You have the gap that was left a long time ago. Price has come down from that gap, but it did not ferociously go down, because in this most recent retracement, it did not even manage to get to the 38.2 retracement. It gives you an engulfing, you take that trade. You take that trade knowing that, hey, I'm still below 78.6 from this downtrend. Because I'm below 78.6, I'm going to be cautious. I'm going to have tight stops. You take that trade. Now, I had some preference, right? When I did this one here, I said this is close enough, I'm going to ignore it. You would not be wrong to say, no, I'm not going to ignore that. I'm going to actually move this, which is perfectly fine. If you say I'm going to, it actually supports this trade, and you'll understand why in just a minute. So when you do this, Here's your 78.6 breached. And now you say, you know what? I'm taking to the upside. Because this is breached and price is remaining above it. I'm taking to the upside.
Yeah, you would just delete the old one, right?
Yeah, so you draw this one. Find a retracement. So it retraced to 38. It gave you this engulfing, but then the next bar did not go higher, so you have no entry. It came down. It did not give you a good like sticking out kind of hammer. You actually have an inside bar, so down the road we can add inside bars. I don't want to mix it up for now. You only do those 4 things. So you didn't really get an entry here, so you skip this one. But what you see here now is, okay, this has been breached, so I'm moving my fib, and boom, here's my entry. It supports the idea of going up because this broke the 78.6. Like if you had redrawn it. This is why it's critical to, in your plan, in your trading plan, when I say move this if it breaches, this is where you start to refine your own plan. Right now you're trading Beanie's plan. But as you refine your plan, you might say, you know what, this is, to me, this is not close enough, I'm moving it. Or you might say, I don't want 38.2. If it breaches 23.6, I'm moving it. Right? This is where you start to refine your own plan. This is breached, higher highs, higher lows. Really based on those 4 patterns, this is where the entry comes in. You take this entry, man, let's measure this. Let's measure it actually with actual. If you were to take this trade a penny above this bar and you put your stop a little like at the 38.2 and look at this number 1.26, we move it until it says 2. We are out of this trade. We are out of this trade with a 2-to-1 ratio.
So a couple more questions on this. So when I look at this, definitely I think like in hindsight, like now it makes sense to me. My biggest concern, and I like this week I try to just like, find some time to just do some paper trading and identify like what's my entry if it were to happen in real time. And the biggest concern I had is on these like small retracements that are not deep enough to give me confidence, like, is this gonna well, it's just not a deep enough retracement when I look at it because it barely even breached the 23.6. And so how does that, do you just, regardless of the retracement, whether it's small or deep, do you just count on your entry points as the bars and if it gives you your entry points based off your game plan for the bars instead of the retracement amount? Because when I look at it and when I see a nice deep retracement and then a bounce back from that, that's kind of how I've been, at least in my head, been envisioning the entry points.
Okay, that's a good question. Remember I said my sweet spot is green to green.
Yeah.
Right? It has to come down to 38, preferably stays above the 61.8. This is my sweet spot. This is where I want to see the reversal.
Exactly.
However, to me, a shallow pullback means it's above the 23.6. It did not even come below 23.6. Those ones I ignore. Right? I consider some sort of a consolidation. I ignore them. That's not deep enough for me to enter a trade. Even though this is my sweet spot, anything below 23.6 I'm taking. Anything above 78.6 I'm taking. This is a sweet spot, but red to red I'm taking.
Okay.
Uh,
Would you just
case
be
by
more
case,
careful?
right?
Yeah.
What was the question? Sorry, I missed it.
No, I was gonna say, would you just be more careful in terms of like you'll be very cautious, and then you'd have, obviously it's not as shallow or deep as a pullback, so you'd kind of just position wise, maybe you'd be more conservative.
So not really position wise be more conservative is if it has just started to make a new run. I believe this is a new run, right? Based on we broke the
Yeah.
78.6 here. This one is a new run. It's just at the
Mm-hmm.
beginning of the new run. I'm not afraid to take this position. If we
Mm-hmm.
had seen 3, 4, dips, then I might say, you know what, this is a potential for a market exhaustion, and it might start to pull back, and so I will either have very tight stops or I will have a smaller position size. But that's a very good question, right? But in this
Yeah.
instance, where I would have my stop, if I see this engulfing and if I take this, I would have my
Yeah.
stop right at the 38 point. I would
Okay.
say I was wrong if price, instead of going up, it starts to go down. But
Okay.
here,
That makes sense.
remember, target 1, target 2, target 3,
Yeah.
we opened right above target 1, so you better take your profits here because you don't know what it's going to do from here.
Yeah.
And target 2, man, that same day it gave you target 2, the same day, you better take it. Right?
Mm.
Don't wait until target 3 because it gave you. Now your stop at this point, my stop is target 1. If price comes
Yeah.
back down to target 1, I'm out.
Mm. Okay.
The remaining 25%, right? Because
Yeah, because you
I'm
need
going
your
for
stops up.
the target 3.
Yeah.
So
Okay.
it's not how deep, it's where am I in this current trend.
And would you look at just the current trend, like just the current peak, valley to peak, or would you look at the reversal trend and how many of these we've had? Because if you look at it, we're kind of on the second peak right now from
So
the
this is
reversal.
one. To me, this
Yeah.
is first run,
Okay. So you count that as the first run. Okay.
second run.
Okay. Nice. Okay.
If
Sounds
this
good.
is like third run, right up here,
Yeah.
I want to see a deeper pullback before I enter this one.
Mm. Okay.
Right now, this
It
is
also
here.
even lines up as support right there. Yeah.
Yeah, I don't want to enter here.
Or
I want to
resistance.
see
Sorry.
price coming back down to this 402 area before I consider entering.
Yeah, because I'm just looking at that. Even like if you draw a line across the top right there, it's like resistance right there at the high of the close. Yeah, right there. Yeah,
That's where we are, right? We are right at
yeah,
that
exactly.
resistance.
Yeah.
That's why you better take your exit 1 and 2 and 3.
Mm. Okay.
Right from here, this is, you're getting resistance right here. So, usually I take the third one. I don't wait up here because this has already told me I tried, I failed.
Yeah.
Look, there's a big wick here,
Yeah.
right? So during this movement, I've already taken target 2 because I crossed it. I have already taken that. But when I
Yeah.
see this rejection, I'm most likely going to exit the trade
Mm.
because
Interesting.
again,
That also makes a nice continuation play, though, if you look at that based
sorry,
off the other game plan, because that's a hammer right there at the 3.
this is not a hammer to me.
The other one
This
at the
one.
very end. Yeah.
So remember, for me, a hammer has to come at the bottom and it has to stick out by itself. An inverse hammer has to come at the top and it has to stick out by itself. That's how I like to trade them.
You're right. I
Right?
reversed it.
Yes.
This would have to be an inverse hammer to be.
An inverse hammer sticking out by itself,
Yeah.
not in the middle like this. Now, you can talk to 10,000 more other people and they'll tell you this is a continuation, take this trade.
Okay.
Right? And I will not say they're wrong. It's just, to me, that doesn't fit my trading plan.
Mm.
It's always about your trading plan. It's not somebody else's trading plan.
Okay. Thanks, Bean.
My purpose is to help you create that optimal trading plan for your style. Right? That's my goal.
Yeah.
But to get you there, I have to start showing you how I trade.
Mm-hmm.
And then as you start to paper trade, you start to see, you know what, some of these things, I'm not quick enough. Or on these things, I can be quicker by making this tweak. Then you go for it. That's what you want to do. And if we look at here's a supply zone. So when price comes here, price is struggling. It's struggling to get above this zone. Right? So now what I want to do is like stop on this for today, and I want you to really think about how you put everything together when you're selecting a trade. I don't want you to go like this and say, oh, this moved up, I'm selecting this. Right? I don't want you to do that. I want you to say, here are the 5 conditions I need met. Those 5 conditions were met, so I took this trade. And this is daily on February 2022. So if we go back to let's replay it. Let's replay it to here. Change it to hourly. So if this was an entry, I still don't see the kind of entry I want, right? This is a nice reversal, I know, but I don't have a hammer, I don't have an engulfing, I don't have a railroad tracks. So it will be very difficult to enter that trade. The lower time frames might show you something. The lower time frames. Let's see if we can find. Oh, I think we're gonna struggle to go all the way to February 22 and the lower time frames. So again, the point is, yes, we can see, right? Yes, we can see this was an up move, but was there anything that told us this was supposed to be an up move when we got here? What was our entry? If this is what we see, was there anything on this chart that says, hey, I'm done going down? You have to know that answer before you take this trade. Because if this was live, when you see price is, sideways up, sideways down, sideways up, sideways major down, do you take this trade right now? Even if this was a hammer, would you take this trade?
No.
If this was a hammer, would you take the trade?
No.
No, because there's nothing that tells you, as a fib retracement or anything like that says, hey, it's time to get in. It's okay to miss this trade. It's okay to miss this trade. You're actually, if you draw your fibs, you're only going to miss part of it, not all of it. Right? When you see I breached 78.6 and now I'm only interested in this, this is all I'm interested in. Boom, in the sweet zone. You get this engulfing here. It engulfs actually not one bar, it engulfs like 7-8 bars. This is now conviction. Somebody's saying, hey, you bears, you are done. We're tired of you. Right? A penny above it comes this bar here. You enter the straight. 378. You have your stop here. So you enter here. You have your stop right here. This is the bar you enter. And you want to exit at 2. I'm just using this to show you that, hey, even if you just say, I don't care about the fib levels, I'm exiting at 2x my risk, you've already made your money. But if you're going to say, hey, I want to wait until target 1, boom, you hit target 1 as well. Right? You did not pick this. You did not pick the bottom. Nobody knows the bottom. But you participated in that up move.
Yeah. Quick question on this one. You said that, can we zoom in a little bit more on the engulfing bar? I would like to kind of just look at it a little bit more.
Go to the left.
So why would you, no, the one we are entered at. Yeah, that one right there.
Yeah.
The engulfing bar. So why would that be, I guess, why wouldn't you enter the next day? Because I would look at that and say it's engulfing the next day, and then I would enter on, if this, this is the hourly. So I guess I would enter like the next hour, like 2 hours later.
This is where tweaking your entries to your style becomes critical. I say I will enter when I get a penny above this engulfing bar. And I don't get that until about this bar or this bar, right? So this high, 377.02, I got it at this bar. This is where I'm entering. You can say, I've already engulfed all of these bars. I'm happy. I'm actually going to get a cheaper price than you. I'm entering. It's all good. Because you opened here, so you actually opened slightly better. Instead of 377, 373. If you are consistent with that kind of entry, all the power to you, because that's what I want you to do.
Okay.
Right? It's all about tweaking your entry based on your trading style. And what you're actually doing, if you and I agree the stop is this, if we agree that we don't touch the stop, and we only change where we enter. And if I move my entry down here, what you're essentially doing is you're getting your exit much sooner. Right? Because our stop should be the same, right? Both of our stops should be the same.
Yeah.
It's very similar, right? Very close. But for the risk reward, you're taking a risk, smaller risk than mine, because you're entering at a better price, and you're exiting sooner.
Yeah.
It's so, but if we're talking about dollar allocation, it's the same. Like I'll buy 10 shares, you can buy 12 shares.
Yeah.
So the dollar allocation is the same.
Yep.
But it's about consistency. So if you say, as soon as I see engulfing, I'm taking this trade, this is perfect. But make sure you have a stop, mental stop, to where you're going to exit.
And then that stop, did you just essentially use the bottom of that wick?
So
a little bit below, like, you want to give some breathing.
Look down here, okay? Look at these numbers. And look at this, the last number in white. That tells me the average range of deer is $6 per day. That's the average range, high to low. So if price happens to close very, very near this bottom here, For me to say I need to give it enough room to breathe, I need to give it a $6 move to breathe. So I'll go from this low down $6. I don't know where that is, right? So this drawing here is not taking into account the exact entries and exits, just roughly.
Mm.
But my exit is, I'm gonna give it wiggle room, and it doesn't matter how wide this is, because you have a percentage of your account you're going to allocate as a loss that you're willing to accept. So if it's one share, you only do one share. If it's 100 shares, you only do 100 shares. How wide this is irrelevant, as the maximum you can lose is tied directly to how many shares you buy and where you place your stop.
Yeah.
So the wider you stop, the less shares you buy to minimize the impact. And when you go, the wider you are, you have to also remember the more you need price to move to get you that too. But if you're using the fib extensions, or if you're using the like, you say, oh, this has moved like this from this, here's my exit, right? If you're using the extensions as an example, you can exit sooner. Or if you're using the retracement where it gives you that negative 2.72, negative 27.2, then that's where you have your first exit, your second exit, and so on.
Okay. Thanks, Beanie. That's helpful.
Yeah. So let's keep practicing those entries. I encourage you to find a brand new ticker for this exercise, and the best thing you can do is go to weekly, find a random spot not too far out, and replay, boom, and then you just, as you play forward, you make your decisions. This way you're not biased, right? And you can move this, I don't know on the free version if you can move it 10 times or if it's only one time, but you can move it, and you can go forward or you can play. Like forward means bar by bar. You can go like that, or you can, if you play at this speed, it will play. And so when you see it's retraced, you can pause it, do your fibs, make a decision, and go. That's what I recommend you do. That way you're not biased.